Welcome to Animal Spirits with Michael and Ben. I suppose this was inevitable. So Reed Hastings has a new book out about the culture at Netflix. And so,
by the way, I can't believe his people decided to drop the book the same week as Morgan Housel's The Psychology of Money. That's a ballsy play on his part.
Isn't it kind of interesting, though, that he's doing a book when he's not even retired? Because you've been seeing a lot of CEOs who are in their retirement phase doing it, but he's doing it while he's still there, unless he's maybe phasing out soon.
I'm retired from reading about Netflix.
Okay, yeah, right. You've read like 4 books on them, have you not?
I'm saying, yeah.
Okay, so you're not. Yeah, I probably don't need to read this either, but I think you got the gist of it from the 347 interviews he did over the past week. But the part that I pulled out from the Wall Street Journal interview, they asked him, have you seen benefits from people working at home? And Hastings replied, no, I don't see any positives. Not being able to get together in person, particularly internationally, is a pure negative. I've been super impressed at people's sacrifices. And then they asked, how many companies are going to shift to work from home even after the crisis? His guess was he thinks a 5-day work week will become 4 in the office and 1 at home. That's where a lot of companies will end up.
That's reasonable.
Yeah, it is, but probably not the way many people would think. So he's not sugarcoating it. And I'm sure there are a lot of CEOs and type A personalities who just hate the work from home concept. I'm guessing especially at big corporations. So another Wall Street Journal story last week said JP Morgan executives told all their senior employees of their sales and trading staff that they have to be back in the office by September 21st. So the backlash of this is starting to happen a little bit, right? Where we get these companies who did it because they had to, and now they're saying, all right, you know what? We're going to figure it out, and people are coming back whether they like it or not.
So there's backlash within companies, people that have the ability to work from home and people that need to be in the office. But I think there's a bigger backlash coming in the broader economy versus people that are able to work from home versus those that are not. Bloomberg shared a chart. Naturally, Americans with higher incomes were more likely to telework in August. If you made between 50 and 75 grand, you were 30% likely to work from home. And it just increases. Basically, the more money you make, the higher chances you are from working from home.
Right. People who made 200,000 above, over 70% of them were able to work from home. Whereas if you made less than 25 grand, only 11 or 12% of you were able to work from home. Here's the other side of this. Now, a lot of people say this is the inequality stuff at work, and I agree with that. I think this chart is going to work against high earners in the future, though. Because I think unless you're at a really cushy company that loves their employees and perks galore, they're going to say, all right, you make a lot of money, you come to the office. I don't care. So you've been able to do this for 6 months because we're in a pandemic, but guess what? Pandemic's over. You make a lot of money, you get your butt in here now, and you're going to be in the office 5 days a week, whether you like it or not. I don't care what you want. I think that's going to happen.
I agree.
I think we could see a lot of that, especially if you're working for a big corporation. And so the other.
So one of the dividing lines is within companies. It's people that have kids that are getting extra accommodations for good reason versus people that don't have kids.
So this was in the New York Times, and they talked about how when this stuff all happened, a lot of the employees needed childcare because a lot of that was closing down for people. And so this said at a recent company-wide meeting for Facebook, employees repeatedly argued that work policies created in response to COVID-19 had primarily benefited parents. At Twitter, a fight erupted on an internal message board after a worker who didn't have children at home accused another employee who was taking leave to care for a child of not pulling his weight.
Was it a quote tweet or a subtweet?
But, I mean, honestly, I'm biased here as a parent, but those single people can F off. Right? Right? Like, think about it is so not easy to be a parent during the pandemic, and like, where's like the camaraderie and the teamwork? And you know what? I'm gonna pull up a little more slack. But I mean, if this is happening now, I mean, think about like the political backfighting that's gonna be going on. If certain employees have work from home status in the future and certain employees don't, this is not gonna be good for a lot of big corporations that have internal politics.
Why don't you go back 10 years in time, Ben? If you pre-children, you would have been so pissed off at parents. And so would I have. This is bullshit.
I guess. Yeah, maybe I'm just more understanding now and realize that it's a little harder. But this just shows in the future, the political, backstabbing is going to just be ramped up, isn't it? If those people who are at the office, they're going to be talking smack about people who aren't there and trying to leverage it into a better opportunity or I just think that's where we're headed with this stuff. If certain people get it and certain people don't at companies, I don't know how it's going to work.
For sure. So another headline, VMware and Twitter cut pay for people leaving the Bay Area. Is this fair or unreasonable? I think it's fair.
Yeah, I mean, you base your pay on standard of living and cost of living, but don't you think that really high-level employees are going to say, I don't care what I do for you, you pay me whatever you pay me wherever I work? I'm sure there's going to be people who fight against this.
I understand that mentality, certainly, but I feel like companies that are located in areas with high standards of living have to compensate their employees for that. And if you leave, then you don't need to be compensated that way. Now, I don't know what the exact numbers are. Like if you go from San Francisco to Bozeman, for example, and you get a 20% reduced pay, is that fair? I think so.
So don't you think there's going to be workarounds for this, though? So in college, you couldn't live off campus until you were a junior. But we had a friend who used his parents' address at a town a half hour away just so he could live in an off-campus house somewhere. Can we get some of that where someone still pretends to live in San Francisco but really moves away and just says, I'm going to be working remotely from San Francisco? I don't know. But sure. This just shows this. It's almost been easier to do it through this 6-month period because everyone was in the same boat. So once those restrictions are taken off and the pandemic is over and we're back to normal and people try to navigate this, it shows how challenging it's going to be for companies and employers to figure out what to do and what are the right steps to take because there's no playbook for this.
It's going to be messy.
Yes.
It's going to be messy. This is interesting. Finally, the consumer price index for college tuition fell 0.7% in August. That was the steepest drop since 1978. On a year-over-year basis, the index was up just 1.3%, and that was the smallest increase on record, which is pretty remarkable.
How is it still up during a pandemic?
Well, Jesse Livermore, who we're going to get to in a minute, wrote about this idea. What a freaking brilliant piece that was. I mean, I admittedly skimmed a lot of it. I did get to the end, but I feel like that should be required reading for Fed officials.
Maybe for investors. How about just for understanding what's going on in the markets right now? So yeah, he wrote a commentary for O'Shaughnessy Asset Management called Upside Down Markets.
But before we get to that, let's just talk about Druckenmiller really quick.
Okay.
So Stanley Druckenmiller was on TV, and he is widely pointed to as the best macro trader of all time, hands down, right? Everybody respects him. Economists respect him. Traders respect him. And to his credit, he said something like, listen, I have no idea where the markets are going to go in the near term.
I have no clue where the market's going to go in the near term. I don't know whether it's going to go up 10%. I don't know whether it's going to go down 10%. But I just want to remind people that there is no valuation support because we dropped 10%. That hasn't mattered because we're so far outside of the valuation realm with the Fed doing what they're doing. That doesn't matter. But I would say that the next 3 to 5 years is going to be very, very challenging. And what the Fed has done, in my opinion, if you listen to the Jackson Hole speech on the framework, it was quite amazing. It sounded like an apology because inflation has been 1.6 instead of 2 the last 10 years. Well, their mandate is price stability, where I think 1.6 is like they hit a home run. They actually sound like they've been too tight the last 10 years. And look what they're risking in terms of financial stability to hit that 2% mark. And my own sort of central case is, for the first time in a long, long time, I'm actually worried about inflation. Unless everything I learned about at Bowdoin is incorrect, de facto MMT, which is what we're doing right now, because we actually have the chairman of the Federal Reserve with a $3.5 trillion deficit out lobbying Congress to do more spending and guaranteeing those of us on Wall Street that he'll underwrite it. I think it's dangerous. I think we could easily see 5 to 10% inflation in the next 4 or 5 years. Ironically, I also think he's raised the risk of deflation, because I cannot find a deflation that happened because you were near the so-called zero bound. Everyone was preceded by an asset bubble, and he's created this massive asset bubble. So ironically, he's raised the two tails. The risk of inflation is is much higher than I'd say it was 12 or 24 months ago. And the risk of deflation, I'm talking like minus 3 or 4%, because if things don't work out and we get a bust here, that is up. I think the odds of us hitting the sweet spot, which I would say is around the 2% area, which is where we've been, have actually gone way down with the Fed activity.
Doesn't this sound kind of, he's saying that the risk for inflation and deflation are higher than they've ever been? I just feel like he's been bearish for a long, long time. And so have a lot of people, but can you be have you ever heard of a macro investor who's bullish?
Not certainly.
And I guess in Druckenmiller's case, when you make a living betting against central banks across the globe, you're going to have a bearish bet. That makes
certainly
sense.
I haven't seen any bullish ones since the great financial crisis. I think if you had macro in your title somehow or your newsletter, you've been bearish because
maybe Mark Dow.
Yeah, but it's one of those things where
Cullen.
I think a lot of the people who follow central banking and follow macroeconomics are using a playbook from another time. And I'm not saying this is necessarily Druckenmiller, because obviously if he invested exactly the way he talks, his returns would be horrible, because he's been betting against the Fed for the past 10 years. And to his credit, a few times he said he's been wrong. So I'm guessing his investment portfolio does not match the stuff he says. It's watch what they do, not what they say type of thing. And that's the way it is for a lot of hedge fund managers. I mean, you follow someone like Ray Dalio, it's the same way. They always sound bearish, but their portfolio doesn't match what they're saying. But I think there's so many hedge fund managers. This is why, since the great financial crisis, have we had a single superstar fund manager that has just shot the lights out? I mean, isn't the biggest star fund manager right now just the NASDAQ 100 ETF? There hasn't been a single one, and I think because a lot of them are using a playbook from the 80s and 90s and early 2000s that is completely gone, and it doesn't work anymore. The market has changed, and they were all waiting for hyperinflation from the Fed keeping interest rates low for years, and it never came.
So maybe this is a good lead into Jesse Livermore, who is a modern day, I don't know, genius? What do you even call this guy?
His understanding of the markets is phenomenal, and it is kind of funny that in the information world we live in, that a pseudonymous blogger is kind of schooling everyone on what's going on in the markets.
The way that he breaks down concepts and re-pieces them and looks under the hood and rebuilds them, and I mean, it's remarkable. This took me a long time to get through. It was a slog, but there's a ton of
it's a 40,000 word piece. So we tried to pull out some of them. So again, it's called Upside Down Markets, and he's looking at what if we have this shifting regime where we're going from monetary policy being the most important driver of markets to fiscal policy, which is something that we've been talking about for a while. And the way that he explains it, he kind of breaks down the economy as a whole and how it's looking and how things change if and when that happens. And he calls it upside down markets because he's saying this is the reason you can have a bad economy and strong asset prices. He makes a perfectly good explanation for why when you have such strong monetary and fiscal policy as you did this year, even during a nasty economy, you can still see asset prices rise because people know, okay, the government has these corporations back, and we're going to be willing to look over the valley for a year and know that this next year is going to be bad because these corporations are going to be helped out by the government and everything's going to be fine. And that's really the way things have played out this year.
So getting back to what we spoke about college earlier, like how is this happening? I thought this is very smart. He said, industries that aren't able to appreciably increase their productivity tend to experience above trend inflation. They rely on labor supply whose cost is increasing faster than inflation, but they aren't able to use that supply any more efficiently to generate output. So they have to pass the cost on to consumers, raising prices at a pace that exceeds inflation as well.
So Mark Andreessen was on an A16Z podcast this week talking about the fact that things like healthcare and college, inflation are just out of control, and those are the things that hurt the middle class, and that's one of the reasons that we have wealth inequality. So he broke it down, and this chart that you put in here is great because it's looking from May 1998 to January 2020, and televisions are down 16% over that time, which makes sense. We talked about this a couple weeks ago about how it's harder to manage inflation. And the higher ones here are hospital services and daycare and nursery and college tuition, of course. Those are all running much higher. And this is why people complain about inflation as a measure.
That's his point. That's his point. You can't, like, things that you can't get higher productivity on, basically things that are technology related, costs tend to rise faster.